You know the feeling. A few taps, a quick swipe, and your stock order is executed. It feels instant. Total, frictionless access to the global financial markets right from your phone. But that frictionless experience is a carefully engineered illusion. Behind that clean user interface lies a massive, invisible infrastructure doing the heavy lifting. Modern markets do not actually connect you directly to a seller. Instead, they rely on a complex network of hidden intermediaries, highly specialized entities designed specifically to intercept your order flow and absorb the underlying risk. To understand a trade, we deconstruct its lifecycle across two layers. First, the micro layer of payment for order flow, where market makers intercept orders before public exchanges. Second, the macro layer of continuous net settlement, offsetting daily trades so only a fraction settles later. The sheer volume and speed of modern trading are not achieved by eliminating middlemen. They are achieved by engineering these exact two layers to systematically extract risk from the financial system. Let's zoom in on the exact microsecond you submit an equity trade and an off-exchange wholesaler intercepts it. Wholesalers pay for this retail order flow because of the Gloston-Milgram dynamic. This economic model suggests that market makers profit most when trading against uninformed buyers and sellers, allowing them to completely avoid the toxic adverse selection risk of trading against highly informed institutional algorithms. This histogram shows the realized spreads devoted to sub-penny price improvement. Notice the heavy right skew. This tells us that realized spreads for retail trades are overwhelmingly positive, making them highly profitable for these market makers. This creates an operational trade-off. In exchange for exclusive access to this highly lucrative retail flow, wholesalers pass back a portion of their profit as sub-penny price improvements directly to the retail trader. Looking at the red line on this price improvement chart, these fractional savings keep $20 to $30 million in investors' pockets monthly, and the green line shows this happens even at the minimum single-tick width. But that highly efficient reality is specific to equities. The options market operates under completely different constraints, most notably featuring much wider minimum tick sizes. This creates a structural paradox. Routing options trades generates double the payment for order flow revenue for the brokers, but because of specialized exchange rules, market makers are able to extract wider spreads, ultimately delivering mathematically inferior execution to the retail client. So in the equity markets, off-exchange routing does not function as an extractive tax on the retail investor. It operates as a highly efficient, data-backed subsidy that makes zero-commission trading possible. Despite these numbers, a common professional critique remains: the fear that retail orders routed off-exchange are subjected to predatory high-frequency latency arbitrage. To test that fear, we have to look at the data. Specifically, we analyze the microsecond discrepancy between the participant timestamp recorded at the local exchange and the SIP timestamp recorded centrally. On this graph, top red lines show non-retail trades have a 40% timestamp discrepancy, the hunting ground for predatory algorithms. But for the teal retail lines, discrepancy drops massively to under 10% at the central participant versus SIP node. The steep drop-off proves that retail orders are consistently executed during periods of profound market stability and low price dislocation. The reason is behavioral. Human retail traders do not submit orders with aggressive, high-frequency timing considerations that trigger short bursts of volatility. Behaviorally, human retail traders don't submit orders with aggressive timing that triggers extreme volatility. And looking 3 milliseconds before or after execution on this chart, retail quote discrepancies remain flat and consistently low. The fear of retail latency arbitrage is an illusion. Retail sub-penny execution is structurally insulated from the microsecond volatility that actively plagues institutional flow. Executing a trade in a microsecond is only the first half of the equation. Now we look at the multi-day reality of trade settlement. The U.S. Cap-Hill markets process tens of millions of individual daily transactions, creating a crushing mountain of obligations between hundreds of different brokerages. Managing that chaos falls to the Depository Trust and Clearing Corporation, or DTCC. Its core function is to legally interpose itself as the central counterparty to every single buyer and seller in the market. Through continuous net settlement, daily trades are aggregated and perfectly offset. An astronomical $5.1 trillion in gross volume is netted against each other, reducing the actual funding required by 98%, down to a manageable $400 billion. That massive reduction in funding needs is the only thing preventing daily margin requirements from instantly bankrupting participating brokerages. This absolute centralization of risk effectively quarantines the broader market. It isolates the entire financial system from the potential failure of any single clearing member. Without the radical mathematical efficiency of this continuous net settlement macro layer, the immense volume of modern zero-commission trading would instantly collapse the global banking system under its own weight. So, what happens to this highly optimized clearing system when the market undergoes a catastrophic shock? We see the answer looking back at the peak of the 2008 financial crisis, specifically the chaotic days following the Lehman Brothers bankruptcy. The stakes were massive. The market faced a $500 billion equities exposure, representing the largest, most complex liquidation of a financial services firm in U.S. history. Yet the DTCC's centralized netting architecture flawlessly absorbed the entirety of Lehman's liquidation without having to draw a single cent from other participants' clearing funds. That exact same netting infrastructure successfully managed the emergency transfer of Bear Stearns' massive derivatives book in a single 48-hour weekend. Fast forward to the intense market volatility of the 2020 COVID-19 pandemic, where the system processed a record-breaking 363 million equity transactions in a single day, entirely without systemic contagion. The ultimate test of market plumbing is not its transaction speed during lucrative bull markets. It is its absolute, unyielding resilience during black swan liquidations. We can now synthesize the full life cycle of the modern trade, permanently bridging the conceptual gap between microsecond routing and multi-day settlement. At the micro layer, wholesalers extract realized spreads via payment for order flow, but they utilize that profit to absorb adverse selection risk and subsidize measurable retail price improvements. At the macro layer, the DTCC utilizes continuous net settlement to systematically absorb, compress, and eliminate counterparty default risk on a multi-trillion-dollar scale. The naive retail perception of the market is a direct, frictionless line from a smartphone app to a stock exchange. The structural reality is a highly complex web of risk-absorbing intermediaries. But remember the critical dichotomy of asset choice. This highly optimized retail ecosystem specifically benefits and protects equity traders, while extracting significantly more value from options traders. The profound efficiency and safety of modern U.S. capital markets are not achieved by eliminating middlemen. They are achieved by engineering intermediaries to precisely and ruthlessly extract risk at every conceivable scale of time.